So here we are in 2023, and this is the market outlook. So if you recall, last year, 2022, was a bit of a rough year. Not only did stocks do very poorly, but bonds did very poorly as well. That was a combination of a couple of things, mainly inflation and interest rates, kind of knocking both of those down to bring the averages of around 20% to possibly more, depending on where you were invested. So going forward in 2023, what does that mean and how does that look in terms of the overall economy? Well, one of the biggest factors, of course, that we're still considering and taking a look at is the federal funds rate. The federal funds rate is the tool that the Fed can use to help either cool inflation or help to drive inflation. And their mandate currently, as it stands, is to cool down inflation. You can see by this graph that the current Fed funds rate is 4.5. Now, they've talked about potentially continuing to raise that particular rate, which would, of course, put more pressure on the market because, again, it is trying to drive down inflation by suffocating supply. And when they suffocate supply, that means people stop lending, people stop doing business. It kind of brings everything slowly to a halt. Now, of course, their goal is to ease us into this period where we have less inflation and we're not necessarily in this period of a recession. However, they are being very cautious around this rate move. So the Fed's main concern is that inflation doesn't come back. And so what they've been trying to watch is primarily the inflation number along with a lot of the jobs numbers, meaning unemployment. Now, the reason they don't want to stop raising the Fed funds rate too soon is that if inflation does in fact come back, then they've created the scenario where they've essentially got to go back to the well, increase the Fed funds rate, which would then bring everything grinding to a halt. So again, their mandate is to slow everything down in hopefully a not so devastating manner, but hopefully, and we've seen some progress in the last couple of weeks, some of that could potentially change. Currently, the Fed has indicated they may continue to raise rates upwards to 5%. And this graph is showing us here that that's not the projection for the rest of the year. We anticipate, and there may possibly be a reduction in the Fed funds rate depending on how inflation ends up. And so you can see that for 2023, that tends to be the peak for the Fed's funds rate. And then in 2024 and 2025, those two years, the rate actually starts to come down. When the Fed lowers the federal funds rate, it actually helps to stimulate business activity and drives the economy forward. So just if you're hearing it or you're seeing it in the news, a higher Fed's fund rate is actually more hurtful for the economy because that means lending has restricted. If it's looser, meaning the Fed funds rate is lower, it's better for business and typically better for the economy. Now, how do consumers feel about this? Well, we've seen the personal savings rate come way down, especially from some of the highs that we've seen back here in June in 2020, April 2020, where it was about 33% of income, and now it's starting to crater, right, to where people are just trying to essentially survive through the inflation and through just some of the things that have happened in the last year or so. But just because the Fed is raising interest rates doesn't mean everything's bad. You've probably seen it on your online savings accounts, which I've actually been recommending, some higher interest savings accounts. You've seen that rate start to increase, which is actually a really good sign for savers and hopefully for bonds going forward. Now, one of the bigger things that the Fed is obviously looking at is the unemployment rate. The interesting thing that has happened is that even though the economy has taken a hit as such through the market in 2021, the Fed hasn't necessarily seen the unemployment rate start to go up, meaning people aren't necessarily getting laid off right away, or if they are, majority of the workforce seem to rotate out through the COVID pandemic. As we see here in this chart, this is the current unemployment rate for the last 5 years. And as you can see, this was the adjustment through the COVID period where unemployment took a little while, but it eventually spiked to upwards of 14, almost 15%, and it slowly made its way down since then. And here it sits at about 3.5%, meaning the Fed necessarily isn't happy with that, but it's still kind of hovering in a really good area where that's typically about the average we see, somewhere around 2 to 4%. Now, that doesn't necessarily tell the whole story because, like I said, through COVID, I've gotten, especially for some of you that I've worked with or clients that I've talked to, is we went through a lot of these scenarios where the company was in this transition period and they were actually giving some really nice deals for people to start to retire. And so you've seen that trickle through the economy. As we see in this particular graph, the labor force participation rate. And this is for the people who are actually working or are looking for work in this current market environment. And so again, this kind of aligns with a lot of that unemployment rate number that we just looked at. However, you see it slowly starting to climb up, but it hasn't come back near some of the levels that we've seen. Now, of course, all of this was contingent on the fact that inflation had gotten ramped up so very high. And especially as we see, and we had seen last year, the inflation number just skyrocketed. Now, this particular graph is showing a change from previous period, meaning what was it last month? Has it come down? Has it gone up? And so it really did peak sometime at around June, I believe is around 9.3%. And it's kind of fallen down since then. It spiked up a little bit there in October, and then it's kind of coming down. So the Fed is really looking for that inflation rate to come down, and they're trying to pair that with increasing the Fed funds rate. Right? Again, as they're increasing, that means the economy is coming to a halt, slowing down. That means it's hurtful for the economy. So they're hoping that they can pause the Fed funds rate, or if they are, they're going to stop raising the rate here in the near future, which should lead inflation, as it's kind of been trajectorying downwards, because a lot of businesses now are starting to catch up. We've seen that through a lot of layoffs, especially around some of the tech industry, right? You've heard of the massive layoffs around Microsoft, Google, Facebook, and to name a few. And so as those are starting to trickle through, businesses are finally catching up to what has happened through inflation, which is driving inflation down actually, which we've seen through some of the graphs and recent readings in the last couple of months. And so what the Fed is really thinking through is, how can we ensure that inflation is continuing to come down? We don't want to pause raising rates too soon, and we don't want to lower the Fed funds rate too soon in fears that inflation would then spike right back up. And so really, if we boil it down, the Fed wants to either continue with the path that they've been on, which has been increasing the rate every couple of months, somewhere in the range of maybe 5%. And with that, inflation should hopefully continue to come down. And then overall, the Fed will say, okay, at this point, we can either pause raising rates or we can start to lower it, meaning making things better for the economy, for businesses to begin lending and hopefully drive the economy upwards and onwards again. And so all of that brings us here to this particular graph, which is the S&P 500, the 500 biggest stock companies in the US. And you've kind of seen the trajectory. This is in late 2020, actually March 2020, through the pandemic. And as such, you've seen things come up, and then we've reached the high there, and then they've started to come back down. Well, as I've been talking about, we haven't seen a ton of breakouts either end of that coin, meaning we haven't seen stocks completely shoot up and start driving the path forward and going up, but we haven't seen them come cratering down, as opposed to what they were doing basically mid last year around June, when inflation numbers had reached some of the highest that we've seen in a very long time, 40 plus years. So what we see, at least in this current environment, when we're looking at the S&P 500, is that things have kind of been in this relatively weird zone where it's really looking for some direction, mainly from the Fed, because as the Fed goes, then the whole market will end up going, or the market is going to feed off of what the Fed is essentially trying to do. And so far, they've been cautious, making sure that nothing has gotten really out of whack on either end. So I know that's a lot of information and charts that I kind of rolled through there, kind of getting a little bit more technical and analytical. However, that is some of the things that we are looking at. And so what does that mean for the investments? Well, it means that even though we consider the economy to be in relatively okay position, we're still being cautious. We want to make sure that we're not putting all of our eggs into one basket, aka bonds or stocks. And so we're still being balanced. We still have maybe a slightly higher allocation to cash. and we're kind of waiting to see what will end up in the next couple of months, especially around what the Fed is planning on doing around the Fed funds rate. And so as we see some of those changes transpire, we will go ahead and make those changes within the investments. So I hope that sheds some light for 2023, kind of where we came from, at least kind of where we think we might be ending up or going. It's not by any means a prediction, and we hope you don't take it that way, but these are some of the things that we're seeing develop in and around the markets, in and around the economy. So it is a pre-election year, which typically in the election year cycles is typically the best year, the third year. So we'll see, and we'll cross our fingers, and we hope that is the case. So if you have some questions, when we know we'll be handling some meetings here, especially given that it's the new year. But if you have questions in the meantime before our meeting, please make sure to let us know. If you have questions, comments, or concerns, don't feel like you can stew on them. Make sure to reach out to us so we know how we can help or serve you best. So as always, I hope you have a great day and rest of your weekend, and take care.